Have you ever looked at your accounting standards and wondered, why is this so complicated? Well, not today. Welcome to Standards Simplified with Cadora, where we discuss our accounting standards away from all the jargons and all the noise in a way that is calm, simple, and understandable. If you're just meeting me for the first time, hi, my name is Okoye Chomadorati, and I'm so pleased that you stopped by today. Today we will be discussing IFRS 5, non-current assets held for sale. Before we get right into the video, I would love to introduce you to the sponsors of our video today. And we have no sponsors. Without further ado, let's get right into today's video.
I was told to have it figured out, to know the rules, to stand my ground. But clarity came when I slowed my pace and learned in an honest, quieter space.
A company would normally keep its non-current assets like machineries or buildings for use in its business to generate profits over a number of years. But with non-current assets held for sale, it's different. The company no more intends to use these assets in its business to generate profits. They now intend to sell these assets. Since the way to recover the value of the assets has changed, the accounting treatment of the assets changes as well. And this is exactly what IFRS 5 is all about. How to treat, measure, and classify a business's non-current assets that are held for sale. We don't just classify an asset as held for sale when we feel like. Before we can do this, there are 5 criteria or checklists that must be ticked. Number 1, the asset must be available for immediate sale in its present condition. This means that the asset must be fully dressed up and ready to go. Not like the ladies that say, I'm ready, and then suddenly remember they need to gloss up their lips. I'm coming, 1 more minute, please. How do I look? Do you think I should add a bit more? Are you sure? No, we mean ready. Number 2, management is committed to a plan to sell the assets. I have a dad who parked his car with an intention to sell it, and the car stayed parked for years. That's not what IFRS 5 means. Management's commitment means board has approved the sale. There is an active program to locate a buyer, and it is very unlikely that the program will be cancelled. Number 3, the sale is highly probable. This means nothing should realistically stop the sale. If everything goes as planned, the company expects the sales to happen, and in fact, if the sale doesn't happen, they will be genuinely surprised. Number 4, the sales price is reasonable. The asking price must make sense in the market. You're not pricing the assets at $2,000 when it's worth $1,000 in the market. So you are not stylishly chasing interested buyers with your price. Number 5, the sales should be achievable within 12 months unless external factors cause a delay. But at the time of recognizing these assets as non-current assets held for sale, we should not be aware of any external factor that could cause a delay in the sale of these assets. All that we know is that in 12 months' time, these assets will be gone. At this point, I know you may want to ask, what if something happens and we are unable to sell these assets within 12 months? Well, the standard is aware. If by the end of this 12 months period, we're unable to sell this asset, we can still keep the asset as a non-current asset held for sale as long as the delay was beyond the company's control. So it was not the company's fault. It was not because of anything that the company did or did not do. The delay was caused by external factors. So we did not know, we were not aware, and there was nothing we could have done about it. That's fine. If that's the case, we can still recognize this asset as held for sale in the next accounting year, as long as it will be sold within 12 months period. Again, at this point that we are re-recognizing it as non-current asset held for sale, we should speculate that, okay, we couldn't sell it in the last 12 months, but this time we should be able to sell it in 12 months time. So yes, in that case, we can still keep it as non-current assets held for sale. Once an asset is classified as held for sale, do three things: remeasure it, reclassify it, and stop depreciating it. So that's RRS. To remeasure it, we value the asset at the lower of its carrying amount, which is its book value, and its fair value less cost to sell, which is its market value minus its associated selling costs. In accounting, we are prudent. We love to report bad news immediately, but with good news, we keep quiet, we stay calm, and we wait until the harvest. And that is exactly what this is about. If we find out that our asset is worth less than it is in our books, we immediately tell everyone about it. But if we find out that our asset is worth more than it is in our books, we keep calm and we pretend like we do not know. In essence, we do not count our chickens before they hatch. Let's drive the point home with figures. So let's say we have a carrying amount or the value in the book as $1,500, and our fair value less cost to sell, which is our selling price less associated expenses, is $2,000. We stick with $1,500, and so we do not record the $500 profit because we have not sold the asset. Now let's reverse it. If our carrying amount is $2,000 and our fair value less cost to sell is $1,500, we will write down the asset to $1,500, and that $500 difference is an impairment loss that goes straight to profit or loss account to tell the shareholders that our asset has lost some of its shine. Why do you think the standard would want us to do this? This is to prevent window dressing of profits. So basically, you are not gaining anything by recognizing your assets as held for sale, at least in that year, until the asset is eventually sold, if it is sold at a higher amount. But at the time that you are recognizing your assets, you are not gaining anything. It's either your asset stays as it is or it reduces in value. So there is no room for you to try to use that as an opportunity to window dress your financial statement or to polish your accounts and make it look cute. This is the IASB's way of saying, no chance, we are smarter than you. Clock it. The next step is to reclassify our assets. Since our assets is to be sold within 12 months, it now fits the definition of a current asset. So what do? We move our assets from non-current assets to current assets in our statement of financial position. The third step is to stop depreciating our assets. Depreciation reflects the wear and tear from using our assets. And since we are no more using it to generate income, depreciation stops. Another reason why depreciation stops is that, remember, we are reclassifying our assets from non-current assets to current assets. And no, we do not depreciate current assets, do we? No, we don't. So all you need to remember is RRS. Remeasure it, reclassify it, and stop depreciating it. While non-current assets held for sale is usually about a single asset, like a truck or a machine, discontinued operation is about a whole chunk of business. Think of it like this: if non-current asset held for sale or held for sale asset is about selling an oven in your kitchen, Then discontinued operation is about selling your entire kitchen, including your secret recipes. There are two criteria that should be met before you can classify an asset as a discontinued operation. The first is the held for sale criteria. So what this means, as we discussed earlier, the management are committed to a plan to sell the assets. The sale must be highly probable. The asset should be available for sale in its immediate condition. The sales price should be reasonable, and the sales should be completed in 12 months. Yes, all of that held for sale criteria applies here. And in addition to that, and a step further from that, is that the asset should represent a major part of the business. With discontinued operation, it has to be a big deal, it has to be a major decision. So it's either it's a major line of business, it's a business in a different geographical location, it's a subsidiary that was purchased exclusively for resale, or it's part of a single coordinated plan to dispose a business. This means we've decided to exit a business line completely. So you're basically selling your assets one at a time, you're moving your staff, and you are closing operations. So a coordinated plan. IFRS 5 tries to make sure that a discontinued operation is reported clearly and separately. It wants full transparency for the investors of a business. So it does this with its requirements for reporting a discontinued operation. The first would be to quarantine the results of the discontinued operation. What I mean by this is we calculate the profit or loss of the discontinued operation separately. Think of it like isolating a sick patient so that the others don't catch it. Number two, it presents the post-tax results of this discontinued business as a single line on the face of the profit or loss. So it places it right below the profits or loss from the continuing operation. This is so that investors can clearly see the impact of this decision and this change on the business. If management decides to sell a discontinued operation after the reporting date but before the accounts are approved, then it's a non-adjusting event that should only be disclosed in the notes, and so it does not qualify as a discontinuing operation at this reporting date. I hope you found this video helpful. If you did, there are a number of ways you can support this channel. Give us a like, that is feedback. Leave us a comment. I love to read from you and communicate with you. I really do. Share this video to someone who needs it. Share it with a study buddy or someone who has a similar goal as you, the goal of improving on the accounting standards. And yes, subscribe to our channel so you can move along with us on our next and subsequent episodes of Standard Simplified with Cadora and every other thing that we in fact have in store for you. Until next time, keep being amazing and cheers to becoming.